What's up, guys? Welcome back to another episode where we are once again joined by Ben. If you haven't already, go watch our first episode with him, episode 17, as we reference a lot of topics from it. We discuss anchor bias, how it plays a role in both the stock market and our personal lives, and ways to alleviate it. Don't forget to leave a review or a like if you enjoyed. All right, welcome back to the show, Ben.
Thank you. Thanks for having me, guys. I'm excited to be here.
Yeah, of course.
So today, I guess we're gonna talk like a little bit about psychology and behavioral finance. Wait, first of all, this is our first episode after our rebranding, so it's an honor to have you on this first episode. By the way, I don't know if you're familiar that we rebranded. We just released this podcast, the Spotify episode actually this morning. So we're now Manifest Your Success. Do you have any thoughts on that?
Wow, manifest your success. What's behind the name change?
Well, if you listen to the podcast, you can find out. But it's basically just like we're trying to go more broader terms, and not just like strictly finance. Like we have a lot of people on and we talk a lot about like entrepreneurship, and we dive into like tangents sometimes, and it's like it's not super strictly just finance. So we're just trying to broader like our brand so we can reach out to more people. More like a self-help thing.
I'm excited to be on the first episode.
Yes, sir. Well, yeah. So today, actually, we're gonna be talking more about finance today and behavioral economics. And most people don't really know the term like behavioral economics, but it's more like a blend of economics and psychology, which I think psychology is everywhere, and it can really blend in any field, whether it be like math or anything. So how would you define like behavioral economics? Like what is it to you, Ben?
Yeah, so humans in nature are subjective. We are not objective with our decisions. There is always some emotion or bias that influences them. So behavioral economics is essentially the study of how our subjective biases and emotions influence the decisions we make in daily life and the financial decisions we make.
Yeah, that's a great point. And I mean, a lot of people aren't like aware of like the fact that like there's so many thoughts that like we aren't conscious of. And like unless if you don't do the research and you don't understand these theories that we have as humans, then you're not going to realize it. And then you might like get down because of it, or you might have a downfall. And that's what we're here to talk about, because we don't want anyone, if you're not aware of these terms like anchor bias, which we're going to get into later in the show, then you're not going to be aware. If someone tries to pull anchor bias on you and you're buying a car and you fall for it, then you're out whatever thousands of dollars, when if you could have just reframed your thought process, then you might have been able to do it. But are you familiar with Richard Thaler, the founder?
No, I'm not actually.
Okay, yeah. So actually, I'm glad that we're doing this topic right now, because I'm actually reading a book right now called Misbehaving. We'll probably link that in the show notes for anyone that wants to read. It's basically, he just talks about, it's literally a whole like 350-page book on behavioral economics. And he talks about how I'm gonna get these first words wrong, but he was studying some work of Kahneman and Tversky's work, and they did a lot like into quote unquote behavioral economics. It wasn't established as behavioral economics back then. He did a lot of work on them, and then he framed this term mental accounting, which really I think like summarizes what behavioral economics is. Like if you hear the word behavioral economics, you're like, okay, those are two big words that I don't know a lot about. But if you sum it down to mental accounting, like it's super simple. So basically he just like he studied this research, and then he framed this term, and he's wrote a bunch of papers about it. And basically this book just talks about him going through the process of how he discovered it, and then like all these terms and whatnot. Awesome.
Yeah,
So
that sounds great.
Yeah, it's a
Sounds
great
like a book I have to read.
Yes, it is a great book. I mean, it dabbles into like more like it establishes like what behavioral economics is, like the first like part of the book, and then it dives into a lot more applications, which is nice. Like I'm in a section right now where it's talking about like stock markets and movements like that. So it's really a broad, like it's a great read. You can really learn a lot from it. But I guess let's go ahead and get into anchor bias.
Yeah, so Ben, how would you define anchor bias?
Yeah, all right. So I have a few examples here. Let's start with a pretty straightforward one. So let's say it's Black Friday, you're going into a mall and you want to buy a shirt. Nice shirt like the one I'm wearing right now.
Okay.
So picture two different situations. The first situation, you walk into the store, you see the price tag is $30 for a shirt that you like. So you might think, okay, I like this shirt, I want to buy it, but $30 is a little too much. I'm willing to spend $20 on this shirt, right? And then in the second example, you see the same shirt. and the price tag is $70, right? So you think the same thing. I like this shirt. 70 is a little too much to spend for a shirt. I'm willing to spend $50 though. It's a nice shirt. So why were you willing to spend $50 versus $20 the second time? It's because of the $70 anchor that was, put into your head by the price tag. Now, all you can think about is no matter what price the store gives you, not only will you think it's expensive, but because of anchoring, you'd be willing to pay a lot more for the same shirt. It doesn't even matter if the anchor is reasonable. This is called the anchoring effect. Unless the shirt is many, many thousands of dollars, if you like it, you're going to have the same emotional reaction where you think the price is just a little too high, but you'd be willing to pay just below it, right? So now let's look at another example. This is a slightly different application of it, but it's the same sort of idea behind it. So let's say I asked you guys, without using a calculator, what is 1 times 2 times 3 times 4 times 5 times 6 times 7 times 8? Kyle, go ahead.
I would guess 212.
It's a lot
Sam.
higher than that.
I don't know.
2000 something. I don't know.
Okay, good guess. Now, so there was a study done where they asked this question to one group of people, and then they asked a second group of people 8 times 7 times 6 times 5. So it's the same problem, but starting from the top down. So now, what actually happened in the study was the people who started from the top, their average guess was around 2,000. And the people who started from the bottom, their guess was around Kyle's. It was around 500, 512. So
Mine wasn't even near that, but yeah. Thanks for that.
You were within a magnitude. So, why were these guesses so wildly different? That's like 4 times larger than the other one. It's because of the anchor that was planted into your head. So when we make estimations as humans, the first thing we see is, okay, well, 8 times 7 is 56. And then I have, 6 more numbers after that. So, let's think of a big number around 2,000, right? Now as for the second one, where you have 1 times 2 times 3. Well, 1 times 2 times 3 is already 6. And you've used up a third of your numbers and you're only at 6. So you think, oh, well, how big can this number really be, In reality, the answer is actually over 40,000. So both of these were very, very off. But that shows you that your guess is always going to be near your anchor. And because your anchor was relatively small compared to this 40,000 number, your minds are biased and they don't actually adjust as much as they need to, at least.
Right, yeah, that's crazy. I never thought about that experiment. They touch a lot on those studies, like in experiments, so they ask questions, whatnot, but they haven't. That's crazy.
I guess I need to go memorize my factorials.
It's the same thing in real life. If you look at how much money the Federal Reserve is spending, they're spending at one point in 2020, they were spending trillions of dollars a week. And, we see these numbers and we think, oh, well, they only spent 2 trillion this week. They spent 3 trillion last week. Something must be going wrong. We don't think about the actual magnitudes of the numbers that we're looking at.
Right. And I want to touch on something too. Now that you mentioned the Fed, I was listening to someone talk about it, and they were talking about how the Fed wants inflation. There's this narrative where they do want obviously
have a 2% target.
Yeah, they want the 2% target, but as far as the fact that they just printed a bunch of money, and for the people that analyze the Fed and their balance sheet, if inflation is going higher and they just printed a bunch of money, they need the CPI and inflation to keep going up because their balance sheet is going to look like a less percentage of GDP. So say for example, they printed all this money and inflation doesn't go anywhere. Their balance sheet is off whatever trillions in debt. But if GDP doesn't inflate as much as the money that they printed, then they're going to look really bad. And they really care about their reputation right now. Sorry to interrupt.
Yeah. So the amount of money they spent is the same either way. But the only difference is it a higher fraction or lower fraction of GDP? So, for a computer, the number is one and the same. But for us people, when we see this, percentage of GDP, we think, oh, they're spending way too much or way too little. And we don't actually look at the reality. Right. So just going into history a little bit, it was discovered in 1974 by yet another experiment. So there were 2 groups of people, and they had to spin this wheel of fortune where all the slices on it were either 10 or 65. And then he split the people into 2 groups. The ones that spun 65 had to guess how many African countries, or what percentage of the UN was African countries. And then the group that had 10, they had to guess the same thing. So the group that spun 65, they guessed that 45% of the UN was made up of African countries. And the group that spun 10 on the wheel, they guessed that only 25% of the UN was made up of African countries. In reality, the number is right around 50%, right? And I'm sure that if you asked both of these groups before they spun the wheel what percentage they thought, they would have both said around, 30, 40, maybe. They would have been a lot closer to the answer. And, that's another example of an anchor. So we have this number, you have this number 10 in your head. And when you're told to make a guess that you may not, exactly know, it's always going to be around that anchor that's in your head.
Yeah, so I'm curious, like, do you have any examples of this that pertain to like the stock market or investing? Because I'm sure
Yeah.
there are plenty.
Absolutely. So, for those of you who don't know, I manage my own trading group for about 2 years now. And one thing that I've noticed is that when people have a red day, their chances of having another red day the next day are way higher than 50%. So that's why you usually see streaks of green days or streaks of red days. I'm sure we've all seen it in our portfolios. Because, like, why is that really? It should really only be a coin toss or whatever. But because of our mental game, we are either coming in confidently or not confidently, and that really can impact us. As a trader, we want to be objective, but biases essentially stop us from being objective. So for a more specific example, let's say you have a strategy that's very, very accurate, right? Let's say 80% accuracy, 3-to-1 risk to reward, which, I mean, for those of you who aren't familiar, this is like a godly strategy right here. Not very realistic. But let's say you had one day where you lost $1,000 with this strategy, right? Now you're upset. You're thinking, well, this strategy wins every day. Why did it not win for me yesterday? And that's going to be stuck in your head. That's going to be stuck in your head the next day. You're going to be thinking, well, what if it doesn't work anymore? What if, 3-to-1 risk to reward is way too much for me? What if, I have to start changing things up? When you're not trading with your full confidence and all you're worried about is being green the next day and you're not waiting for the trade to mature, that is how you lose money. That's how you get into these streaks of red days. And, as traders, it's essentially our obligation to not get stuck in these emotional wrecks, essentially, not tilt.
Wow, that makes complete sense. I guess on the topic of biases, so that, like, we've been talking about anchor bias, but like you see all the time in trading is like confirmation bias, right? So sorry, got a little cold here. All right, so like in technical analysis, right? Some people think it works, some people think it doesn't. I think it's like a little bit of both, and oftentimes people who are trying to start using technical analysis it just turns into purely confirmation bias, right? So if you draw two lines and it breaks the two lines exactly how you thought it would, and then it goes, like, a lot of times that's because like you think your strategy works because you saw it happen, right? You saw the evidence supporting it, but it's all just chance because it could happen anyways. There could be another reason causing it, which makes you think it'll happen every time in the future. And I think that's a lot of the downfall of like people trying to get into like trading or whatever, is because they think they have a strategy that works, when in reality it's just coincidence.
Yeah, for sure. So, I mean, I'm sure all of us trade patterns, triangles, wedges, bull flags, bear flags. So when we're told, let's say, that a bull flag breaks up, that doesn't mean that it always breaks up. It's not guaranteed. It's like an 80% chance or whatever. I don't know what the number is off the top of my head. So, when someone sees this, they're like, okay, well, the last 4 bull flags have broken up. Why don't I go 100x long here? All it takes is one time when you're leveraged like that, or when you're too confident, for you to get totally wiped. So, confirmation bias, anchor bias is the same story there, where you have to be objective. You have to know the facts. Nothing is ever 100% in trading, basically, especially
Right.
technical analysis.
Yeah, I agree. Also, touching more on like stocks in general too. Like, say for example, it's kind of a blend of both of them. So say for example, you come across a stock, and whatever, let's just actually I don't want to choose real stock. Let's call it ABC stock. And so we come across ABC stock, and you just like, you first discover it and you see this news and they're like, oh, we plan to cure all cancers. And that is just like an anchoring like news in your frame. And you invest in ABC stock, and then every years from now you're still investing, but all you're thinking about is the first news that you saw about the stock, and like it was so good, and then any other bad news you see about the company, you just kind of discredit it because you saw this good
They
news.
cure cancer. Yeah.
Exactly. You're like, oh, this is such a good company, like, oh, they're definitely doing everything perfect because they're going to fix cancer. They told me this and they're definitely doing it. And but at the same time, they could be doing a lot different things and a lot worse things, like financially. And if you just have the straight mindset about the first news of this stock, then it's not gonna be successful long term for multiple companies. I mean, you might get lucky with ABC stock, but it's not gonna work with multiple.
Yeah. So I mean, even looking at crypto, all of us here are very, very bullish on crypto and blockchain tech and all that, right? So we know the future, we know what it holds. But that doesn't mean that we only have to long, we can still play both sides, and playing both sides is the key to, being more objective, understanding that, yes, this technology is super, super powerful. However, there might be some more downside here, like Tesla selling its shares or whatever, whatever's happening in the world. And I can name off the top of my head a bunch of really, really good traders on Twitter that have gotten stuck in this bias, and they've really let that be their downfall. So I don't know if you've both have you guys heard of Crypto Capo?
Mm-hmm.
I have not. Please inform.
He's like a top
You're not
trader.
missing much.
Oh,
Basically, he shorted crypto almost perfectly from the top earlier this year. And he did really, really well there. That's how he gained a lot of traction on Twitter, actually. But he held this narrative even after the market turned earlier this month. He's still saying the bottom is not in, the bottom is not in. That's why we see, all these people calling for 5K, 10K Bitcoin, which may or may not come, but it doesn't matter. Right? So he got trapped in this mindset of the down narrative, and he essentially got more entrenched in his anchor because of it. I've made bank shorting before, so I should make bank shorting in the future. That's an example of confirmation bias.
yeah, that's a great point. And it's good, like, to be aware of the news that comes out and not just think, oh, everything's gonna be the same just because this first thing happened and it was true.
Exactly.
I think it's also like super, super easy to get attached to positions like way over the top. Especially if something's making you money, you're not gonna want to let go of it, and you're gonna want to stay in it so that it makes you more money. So it's harder to let something like that go, and you kind of lose sight of what's actually happening.
Yeah, I'm sure we've all bag held stocks in here.
Oh, for sure.
Neo, I still have some Neo in my portfolio. It'll go back up one day, but that doesn't change the reality that I was in profit. I got too greedy. I kept my narrative even after it objectively stopped working, after the stock stopped going up. And I let that kind of lose me a lot of money.
Also, just for the listeners, ABC stock, I just looked it up. American Corporation. They do in fact not cause or cure cancer. So
Oh, this is a real company? Oh,
yeah.
shoot. Oh yeah, that was not financial advice. I didn't mean to reference their company. Imagine they announced like later they're like switching to a healthcare company.
Then in that case, in only that case, that was definitely financial advice.
In that case, we call it first here, folks. Yeah. So I mean, back to crypto. Another example is Plan B, another really, really famous crypto account on Twitter. So he was essentially, he embraced the stock to flow model. He was one of the earliest people, honestly. And his inability to abandon stock to flow after it stopped working, after Bitcoin deviated from that model, was essentially the end of him. He's still stuck in that bias after it's clear that, Bitcoin's not going to 10x after every cycle just because it has in the past. That's not realistic. And I guess what both of these examples show is that there's a line between conviction and getting caught up in anchor bias. And it's important for us traders to find that line and, to understand it, not to go all in. That's why we say to diversify and to be as objective as we possibly can as humans.
Right, that's a great point. And I think it even carries over like into like personal relationships too. And like especially sales, like a huge amount. I mean, I've known like a few people that work at car dealerships, like at my current job, and they talk all about like psychology and like the also the this is kind of irrelevant, but it's not related to anchor bias, but they talk about how I forget the name of the theory. Maybe you can fill me in on it. Where you if you ask them like, oh, okay, did you want this color car? Did you want this red color car? Did you want 4 seats? Did you want a coupe? And they're like, yes, yes, yes. And then you finally get to the question where you're asking them about the money value, and they're more likely to say yes because you asked them all those questions before.
Interesting. I don't know the name of that, but I have heard about that before. Yeah, it's interesting. Another example of how things kind of just stay in your head. And, that's the reason us humans are behavioral, I guess, and that's why behavioral economics exists in the first place. It's because we're subjective in nature.
Right. And it's good to like be aware of what these terms are. So then if you are in a situation where someone tries to pull the anchor bias on you and says, oh, this car's $40,000 when it's really only worth 20,000 just to get you to pay 30,000 for it. And if you don't know what he was doing, then you're going to be out of luck and out of 10 grand that you shouldn't have been.
Yeah, exactly. I hope you don't do that to people at your car dealership job.
No. I don't work for a car. I would never work for a car. I don't think I would. I thought about doing that actually. And I was like, actually, I don't like the way this has worked. If I did, it would be Tesla, because Tesla, they're like one of the only, I think they're the only car company that owns their actual dealerships.
Yeah, they don't have actual dealers. And not to
Right.
mention, they do most of their sales online where, prices are pretty fixed.
Yeah, that would probably be the only dealership I would work at just to get a Tesla too.
Also, I saw the other day in Discord, you were talking to someone about anchor bias and you related it to the price of Bitcoin. So I'd be curious, like you could use that example, but like how does that apply to like the actual price of an asset and how you anchor like a certain price in your mind?
Yeah. So for let's look at an example. Bitcoin hit a high of $20,000 last cycle in 2017. I still remember those days. So for a lot of people, that was their anchor, when in 2020, Bitcoin had its run from like 4 digits all the way to 20K. That's when everyone became profitable. And that's when a lot of people were like, okay, this is the top, we're going to double top here or whatever, because their anchor was $20,000 from last time. Right. It's going to be the same thing with 70K when we hopefully do go back up, because we have these numbers fixed in our heads. And as humans, we have nothing else to reference. We just have, oh, it went this high last time, so it will or will not go this high in the future again.
Yeah. I feel like that also in the same way. So like since 70,000 was the peak, now like you relate what it could go to in the next cycle to 70,000. So you think, oh, it only went to 70,000 last time, so maybe it won't go higher than 80 or 90,000 this time. When in reality, it could go who knows how high. It's not like specifically related to that specific peak.
Bitcoin to 1 million.
Yeah, and that's basically stock to flow model was based off of this historical data, which, if you ask me, historical data before any Fortune 500 company bought Bitcoin is pretty irrelevant now, because, it's not gonna be nearly as volatile now when you have these big players in it who are accumulating and distributing. And looking at this data from back when there were only, like thousands of Bitcoin holders is, that doesn't really matter today. And that's, in my opinion, that's why the stock to flow model doesn't work anymore, just because market conditions have totally changed since it was created.
Right. So I'm curious, like this is more like a general question. So I was talking to someone I met, and they were talking about how like in investing, you can only rely on past like news, you can only rely on past models and past experiences to judge what's going to happen in the future, because that's all we have to work with. Like you have not like everything in the past is controlling our future. But then at the same time, people are like, okay, don't rely, just because it happened once doesn't mean it's going to happen again. And just because it didn't happen before doesn't mean it's not going to happen again, or not going to happen in at all.
I mean,
so
past performance doesn't guarantee future results. That's what all the hedge funds say in their ads.
Exactly. Do you have like any like how do you think someone should frame like their thought process as far as like balancing, okay, history is helpful to like make predictions, but at the same time we can't rely on it so much. Like what would you say to someone?
Yeah. So history can, mean a lot of different things. If you're looking at the history of Apple stock, that may very well be valid, because Apple has been, a steady It's been gaining steady growth. It's been having steady, fundamental earnings reports and all that. And it's been around for a while, right? Now, whereas if you look at Bitcoin, like I said, because in the past it was so different from where it is today, essentially, and now it's all over the news. Everyone knows about it. Everyone's buying it. Everyone's selling it. That past performance doesn't give you much because it was basically a totally different asset back then from what it is today.
Yeah, that's a great point. And like the way like we realize that it's different is because like we see all these things in the news and like all these companies and institutions trying to get in on it. And that's what really, if you personally, I wasn't involved in crypto back then. So I don't really know what the atmosphere was like as far as like on Twitter and like just the community in general. But I can't like, just from what I hear from other people saying, like yourself, like it's a whole different community, and like everyone is so invested in this technology. And it's like, if it gets another bull run and it gets some more momentum, I just don't see how everyone's just going to throw all their money into this project and this technology.
Yeah, exactly. And if you look at people who have missed out on Bitcoin in the past, either they were too late or they never bought it, they're still bearish to this day because they think, well, if I didn't get to make money on it, why should other people get to make money on it? And even if they don't realize that, that's just inherently what they think because human psychology works in that way.
Right. That's a good point. I wanted to touch like on like how you think that as like people we can like become less prone to falling for these like anchor biases and confirmation biases and biases in general. Are you familiar like with the terms acquisition utility and transaction utility?
No, I'm not.
Okay. So this is I'll touch on this and then maybe you can share your thoughts on it.
Sure.
So the book mentioned it and it just sort of generalizes like what you should be thinking about when you're making a transaction. So for acquisition utility, it just refers to like the economic or the financial gain or loss to a situation. So if you're whatever situation you're in, you should always think about the acquisition utility. If you're driving to the whatever baseball game and you spend $80 on a ticket and you got to spend $20 on gas and whatever $10 on a hot dog, that's the acquisition utility. And and you spent, what is that, $110 for the baseball game. So any like situation, you need to think, okay, is this is how much money I'm spending for this event? And if you should always be thinking about that no matter what. So that's acquisition utility. And then transaction utility, it refers to like the pleasure or the displeasure out of it. So say for example, you go to the game and you spend $110 and say you really enjoy baseball games. It's your favorite thing to do and you love hot dogs. So you're willing to spend $10 on it. And your transaction utility is a lot higher than $110. So you are going to make that purchase as a rational economist. So for example, or you could do, if you don't like baseball games, I hate baseball games and I love going to soccer games, and I spent I'm about to spend $80 on a baseball ticket, but it's not going to be higher than the utility that I valued it at, then you probably shouldn't go to that baseball game. And I feel like that's a good way to think about every transaction you have, whether it be like financial or just everyday life.
Yeah, absolutely. Because when you put a value on it before, you go to the game and you see how much it costs, you kind of, that's the best way for us to be objective, is to set a price for ourselves before we see what price they want to charge us. Because then, if you walked into that mall, back to my first example, and you went, okay, I have $40 to spend. If I find something I like that's less than that, I'll buy it. If I find something I like that's more than that, I'm not going to buy it. That's how, that's the best way you can get rid of any biases that you might have when you already walk into the mall. And yeah, I mean, back to what you were talking about before, best way to kind of rid yourself from any anchor bias is, not only to, like I said, to set objective prices for yourself before you see what they want to charge you. The best way for trading specifically is to take breaks. So, that's why for me, after I have red days too, I'm sure everyone has red days. After I have like 1 or 2 red days, I won't look at charts for a week or whatever, it doesn't really bother me. I understand. I've kind of learned to understand that there's no point in pushing it. If you need to take a break for a day or a week or even like a month, that's totally fine, because it's better to not make money at all than to lose money back to back to back. And then one last lesson that I want to leave for everyone is be careful of becoming a product of a narrative that you created, because that's what Capo did. That's what Plan B did. When you create a narrative that worked in the past, but you get entrenched in that to the point of no return, that is when you basically make it impossible for yourself to be successful.
That was a great quote.
Mm-hmm.
That was awesome. Definitely gonna be a clip. But yeah, you made a great point. Like, just make sure, first of all, like, make sure you're informed, and then make sure, like, the break point is so, like, in the book they were talking about how, okay, say you know what the anchor bias is, and you go in and someone tries to use anchor bias on you. Just literally, like, the way he recommended it, and I think it's valid, is walk out of the meeting and then come back and be like, okay, tell me a different answer, and just forget that he even said that answer, and just be like, you offered me $40,000 for a 2012 Nissan with 80,000 miles on it. I'm not buying that. So just walk out and then reframe your mind and be like, okay, this is a new whatever number. I have nothing on the table here. And then go ask him again and see if it comes down. If it doesn't come down, then obviously you need to think about who you're buying a car from.
Exactly.
But
yeah, totally. Because when you stop making the snap decisions and you take a second to, relax and actually think about it and use your objective side as opposed to your subconscious side, that is when you can maximize your ability to make a good decision.
Yeah, that's a great point. And especially, like, even if you're shopping in the mall or something and you see a sale and it's like, okay, buy one, get one 50% off, or buy one, get one free even. But if it's if it's $20 for like a couch pillow or something, and you don't value that, back to what I was saying about acquisition utility, if you don't value that couch pillow as more than $10, then if you shouldn't buy that pillow because it's not worth more than $10 to you.
Yeah, exactly. Or being another example, let's say you're shopping for hats. You only need one hat, but they have a buy one, get one 50% off. You're going to still end up spending 50% more money than you otherwise would have. You can only wear one hat at once. I don't know how many hats a person needs, but if you were only coming in to buy one hat and they got you at that sale, that's when you got screwed, I guess.
Yeah, that's a great point. Coming from my brother, who had like 20 hats on the wall at one point, just like hanging up. And I'm like, dude, why do you know those hats? What were you gonna say?
I was just gonna say I'd take that $10 hot dog over a $20 couch pillow.
Well, it would be two couch pillows for $20 if it was.
I would never buy a couch pillow.
I mentioned Misbehaving as a book. Do you have any other like behavioral economics books that you recommend, or articles or any other?
Look at my shelf. Accelerate is a great book. Wonderful book. It's not directly related to that, but it's absolutely a must read. I think we should do a book swap after we both finish these books.
Dude, I'm ready. What, you come back to school like in the end of the month, right? August?
Yeah, August 10th.
Okay, yeah, I'm totally down, man. I got a bunch to switch with you.
Awesome. Yeah.
We'll have to touch base, dude.
For the pod, guys. This was amazing.
Yeah, this was awesome. Definitely love to have you back on. I mean, there's so many other like behavioral economics things, like sunk costs or the halo effect or decoy effect, that we could just dive into and talk about in general.
Yeah, bro, send me a list of some things and I'd love to take a look and tell you what I'm interested in.
Okay, sweet. Yeah, we'll do that. Appreciate you having on. We're not financial advisors. Anything we discuss may be financial or is for entertainment purposes. Do your own research.